So hi and welcome to the Day Trading for Beginners podcast. I'm Tyler Stokes from StokesTrades.com. And in this episode, we are talking about short selling. So what is short selling and how do you short a stock? So this is episode 10. We're on a journey to become a full-time day trader and we were doing some stock market basics. In the next episode, we're going to talk about options. So I thought it was best to kind of talk about this topic of short selling a stock. It's actually really easy once you understand it. But, I personally had a lot of trouble kind of getting my head wrapped around how this exactly works. So we're going to outline how it works in a very beginner friendly way. We'll have some examples that we're going to go through and we're going to talk about exactly how short selling works. Now, if you're interested in becoming a full-time day trader, I actually have a great resource for you. In the show notes, you can download my 6-month blueprint where I outline exactly what I'm doing in the first 6 months to become a full-time day trader. You can find that in the show notes, or you can go to StokesTrades.com/blueprint and you can download that for absolutely free. And when you do that, you can get invited to our online community through school. I've launched this so other beginners can get together. If you're looking for an accountability partner, you can, find me. You can find someone else. If you're interested in doing this seriously and you really want to become a full-time day trader, we are sort of doing this from the ground up, first principles. So we're going through everything on there. We'll have courses, we'll have guides, and it's absolutely free. No one is selling a course. There's no ads. There's none of that stuff. So you can get more details when you download that blueprint. Okay, let's jump into it. What is short selling a stock? So I knew about, short selling back at university when I took some business classes, but I never really understood how it sort of worked behind the scenes. So it's actually really sort of easy, but there's this one part of short selling that kind of, confused me. I didn't quite get it, but I've outlined exactly how it works in this podcast. So if you're kind of wondering how this works, we're going to run through it here. And then at the end, we're actually going to do an example with some numbers. So sometimes podcasts aren't the greatest for that. In the show notes, I'll have a video tutorial about short selling on the YouTube channel. So certainly check the link where you can kind of see a whiteboard presentation of this short selling example, which is going to make more sense for you if you kind of need that. So what is short selling? What I've done is I've asked ChatGPT and the AI tool Grok from X to give some examples here. So there's one sort of relatable example, and then we'll talk specifically how to short sell actual stock. So here is the example. Imagine you have a friend who has a really cool skateboard that you think will become less popular and lose value. You ask to borrow the skateboard for a while and your friend agrees. You then sell the skateboard to someone else at its current high price, hoping that in a few days or weeks, when the skateboard is less popular, you can buy it back at a lower price. After buying it back cheaper, you return the skateboard to your friend and you keep the difference in price as your profit. So this is similar to how short selling a stock works. So in the stock market, short selling is when an investor borrows shares of a stock from someone else and immediately sells them. Now the goal is to buy the same number of shares back later at a lower price, return them to the lender, and then pocket the difference as profit. So it's like betting that the stock's value will go down. But obviously beware, short selling is risky. If the stock price goes up, instead of going down, you could end up losing a lot of money. So that's really what short selling is. It's selling high and then buying low. So I think we all sort of understand the sort of concept of, with normally when you buy a stock, you buy low and you sell high. And, whatever difference that is your profit. Well, with short selling, you're selling high and you're buying low. But the concept or the part that tripped me up that might be kind of confusing for you is this whole notion of borrowing the shares. So, who do you borrow them from? Do they want to lend them to you? How does that really work? So I kind of was getting stumped by this. So what we're going to do now is kind of dive into this whole aspect of borrowing the shares and sort of how it works behind the scenes at your brokerage. And then we're going to go into an actual example, but that's really what short selling is: selling high, buying low, and then that difference is your profit. Okay, so how it actually works in the stock market, there's, this idea of borrowing shares. So you think a company's stock price is going to go down. So you borrow shares of that company's stock from your brokerage firm. Now, the brokerage firm has these shares either in its own inventory or from other customers' accounts. These other customers are not planning to sell them right away, so they own these shares. So your brokerage firm has access to shares through other people's accounts or their own inventory. Once you borrow the shares, you sell them at the current market price. Then, you wait and you hope that the stock price falls, just like you thought it would. If it does drop, you buy the same number of shares at a lower price. And then after buying them back, you return the shares to the brokerage firm or the original owner. And then that difference between the price you sold the shares and the lower price that you bought them back is your profit. But what I wasn't understanding is that this process is seamless in your brokerage account. So when you short sell a stock through your brokerage account, the process, of borrowing the shares and then selling them, it's typically handled electronically and seamlessly behind the scenes. So it's more like you click a button on your dashboard. So everyone's dashboard is going to be different, whether, you trade and buy stocks through TD Ameritrade or Interactive Brokers or on Questrade or Wealthsimple. Everyone's dashboard is a little bit different. But if your account allows you to short sell a stock, you simply just, access the stock and click short sale. And then that whole idea of borrowing the shares and then selling them immediately, it's sort of done instantly through the brokerage firm electronically. So, initiating that short sale, in your brokerage account, you basically enter an order for a short sell, a specific number of shares and that stock. And then it's usually just done through the interface. And then maybe you'll have if you short sell 100 shares of a specific stock, you'll see a negative 100 in your account. And then you gain that money right away. So again, once you place that short sell order, the brokerage automatically handles the process of borrowing the shares. And after the shares are borrowed, they're sold at that current market price. And that transaction's executed just like a regular stock sale. And then as a trader, you won't see the intricate details of, which specific shares were borrowed or whose account they came from. And there's no need to request borrowing. It's all sort of done behind the scenes. And I think that's what was tripping me up, and maybe it was tripping you up as well. So when you short sell a stock, again, the process of borrowing and selling the shares, it's handled behind the scenes by your brokerage. As a trader, your main interaction is simply to place the short sell order through your brokerage account interface. So you might be wondering, why would the brokerage firm want to lend you shares? And the reason they do this is they make money doing it. So there are fees and interest. So the brokerage firm, they can charge fees or interest for lending out the share. So when you short sell a stock, you're actually going to pay a little bit of interest or fee. And it depends on, what your brokerage firm has set up, but it's not completely free to short sell these shares. So if you hold a short position for a long time, you're going to pay a little bit of interest and fees over time. And then in terms of stock availability, they lend shares that they already have either in their own inventory or from other customers' accounts who are not using them right now. And we'll talk about, how that works as well, or that whole idea of whether you agree to lend out your share. So in terms of risks for the brokerage, it's kind of minimal. The brokerage firm's risk in this scenario, they're not really exposed to any price fluctuations because they're going to get the same shares back. The main risk to the brokerage really is if you, as the borrower, you can't buy back the shares or return them if the stock goes up and you need to pay more for the shares that you borrowed at a lower price. You might not be able to handle that. And in those sorts of cases, they have things like margin calls to manage risk. Now, in terms of margin, I'm just going to quickly talk about that. It's a bit more of an advanced topic for maybe a future episode, but when you short sell a stock and the price goes up instead of down, you actually start losing money. Now, if your losses get too big and you don't have enough money in your account to cover the position, the brokerage steps in with a safety measure called a margin call. So just imagine if you want to short sell a stock and it's at $100 and you borrow the shares and you instantly sell the stock for $100. If it goes up to $150, you now are required to buy that back at $150. Well, if you don't have that money in your account, then the brokerage firm is going to track that and make sure that safety measures are in place, that it doesn't get out of hand, and you won't in the future be able to, pay that back. And I know we talked $100 and $150, but sometimes people have accounts with thousands and thousands of dollars, and if the price goes up, it can get out of hand for some people. So this margin call, it's sort of like an alert telling you to either add more money or securities to your account to cover the potential loss. And if you can't do this, the brokerage will step in and close out your position by buying back the shares at the current price, even if this means that you're going to take a loss. And this is done to prevent the situation from getting worse, and to kind of protect both you and the brokerage from, it getting out of hand. Because sometimes it's risky if you buy a stock or you short a stock and it keeps going up and up and up. You're going to have to eventually buy that stock and return those shares that you borrowed. So if it goes up, then you run the risk of having to buy a stock that's very expensive now and basically return the shares and lose all that money. So again, in terms of risk, who bears the risk? Really, you as the short seller are the person who's going to bear the most amount of risk of the stock price moving against your position. So meaning it going higher instead of lower. And then, in terms of the original share owner, the person who owns the shares and allows them to be lent out, they don't necessarily lose money from lending the shares. However, they are just exposed to any market risk that's normal by the price fluctuations of a stock. So no one really bears the risk, really except the short seller. In terms of, this brokerage firm's responsibility, they're responsible for providing the shares for sale. So when the original owner decides to sell their shares, the brokerage firm is responsible for making sure those shares are available. So I was thinking, also if I borrow these shares and then what happens if that person wants to, sell those shares, but I've borrowed them. So I wasn't really grasping that, but there are so many shares out there. The brokerage firm has an inventory of shares. There's other people stock who don't want to sell them that they can sort of shift around. So, the brokerage firm handles all that. And, if you want to sell your shares, but you've lent them out, then you can just, the brokerage firm is going to make sure you get those shares to be able to sell them when you want to. So again, when you borrow and sell shares in a short sell, the original owner still, owns their shares in terms of market value and rights, even though those specific shares might have been, lent out and sold. The brokerage always ensures that the owner's rights are intact and that you as the short seller, you replace the equivalent number of shares when you close out your position. When an original stock owner decides to sell their shares, the brokerage firm, again, ensures that there's a seamless execution of the sale, even if those shares were currently lent out. So, lending out shares, there's always, it's just going to work out. It's a seamless execution with replacing the shares somewhere within the whole pool of the shares that the brokerage firm has access to. And, the process is managed in a way that the sale by the owner and the borrowing by the short seller, they're both accommodated without conflict. So it's sort of like you click the button and it's done electronically behind the scenes and you sort of don't need to worry about it. But I thought it was good just to go through that process because that's sort of how it works. That's the idea of borrowing the shares and then selling them right away. So you might be wondering, and I was like, did I ever agree to lend my shares out? Well, when you open an account with a brokerage, you're usually required to agree to some terms and service. And in those terms and service, they're going to include perhaps a clause that allows the brokerage to lend out your security. So here in Canada, I believe that with a tax-free savings account or an RRSP account, your shares can't be lent out. But if you have a margin account, the lending of the shares, it's more common in these margin accounts where investors, are trading with borrowed money sometimes. But it can be optional for some accounts. So you can kind of perhaps opt into not lending your shares out, or you can. And sometimes your brokerage will actually pay you a little bit of money if you opt in to lend out your shares and they actually get lent out. So sometimes you can make a little bit of money for lending out shares to people who want to borrow them to do a short sale. So in terms of benefits to the brokerage and investors, like I mentioned, the brokerage is lending out the securities and making money through fees and interest. And then some investors are going to make money from that as well, depending on what brokerage firm you are associated with. So in terms of, this whole idea, we kind of went over how it works, what it kind of looks like behind the scenes at the brokerage firm. And then, why people actually want to short sell stocks. And there are a few sort of basic reasons. Mainly, you expect the stock price to fall, whether that is for any specific reasons, or maybe you think some stocks are overvalued. People short stocks when they feel like the price is going to go down. It's just an investment strategy. Sometimes investors think a stock's price is higher than it maybe should be based on the company's actual value. So they short sell the stocks, betting that the market will eventually come around and the price will drop. And then also, this idea of hedging, some investors short sell sort of as a way to protect their other investments. If they think the market might go down, you can short sell to sort of balance out some losses. Now, in terms of day trading, you can, day trading, you can short sell through a specific day. So if you're reading charts, you're reading candlesticks, and you feel like a price is going to go down, you can certainly set up a short for that. And then in terms of doing options, when you buy a put option, there's this idea of short selling involved. That's sort of what we're going to talk about in the next episode. So just a final sort of summary, and then we'll get into an example. Short selling, it's like the reverse of the usual process of buying and selling. So instead, you sell first at a high price and hope to buy back later at a lower price to make a profit. Again, people do this when they think a stock's price is going to fall, either because it's overvalued or, as a strategy to balance their investments. And the process there is when you short a stock, you are instantly borrow the shares and sell them right at the market. And then you need to buy them back to give them back to the person you lent. But that's all done electronically, seamlessly behind the scenes with your brokerage account. So now we're going to do sort of an example. And again, in the show notes, I'm going to have a link to the YouTube video in regards to short selling. And I'm going to actually walk through this example on sort of a whiteboard so you can see the numbers, but I'll just kind of go through it here. You might be able to benefit from listening to it as well. But again, check that video out so you can kind of see as I write out the numbers on a whiteboard. But this example we're going to talk about is in regards to the company Nikola Corporations. You may have heard of them. They were that trucking company, electric trucking company, and also had some fuel cell ideas. And basically, their founder, Trevor Milton, was found guilty of fraud and sentenced to 4 years in prison. So basically, he made false statements about the company's technology and future sales prospects, kind of pumped up the stock. He claimed that Nikola had developed a working prototype of a hydrogen fuel cell powered semi-truck called the Nikola One, but actually in reality, the truck was not ever fully functional, and it was powered by its own propulsion system. There was this video of it going down the road, and actually it was a bit of a hill, and that's how the truck rolled. It was never actually a working prototype. Milton, I think he also claimed that Nikola had developed some breakthrough battery technology that would, double the range of electric vehicles, but this never existed. He exaggerated the company's production capabilities as well, leading investors to believe that Nikola was further along than it actually was. And the scandal broke in September 2020 when there was this report from Hindenburg Research, which is a short selling investment firm, they expose many of the company's false claims and misleading statements. After the scandal broke, Nikola's stock plummeted, leaving many investors with significant losses. And the company sort of has tried to distance itself from Trevor Milton, but damage and reputation, it has been substantial. Now, I remember back in 2020, when this story broke, I was thinking, hey, maybe I should short the stock. And I never sort of did. Obviously, in hindsight, I should have. But back then, I wasn't really as comfortable as I am now with this notion of short selling. But, if we look at some of the numbers based on, if you shorted Nikola in 2020. So this would be a great reason to short a stock. There's some fraud. The owner is lying and misleading the company. You short sell it thinking that the price is going to go down. So in terms of the numbers, September 2020, the price was about $35. So imagine at that price, at $35, the news breaks. So you predict that the stock price will fall significantly due to the scandal. So you're going to set up a short sale. And this is how it would work. So you decide to short the stock. You borrow, and let's just say in this example, you borrow 100 shares from your brokerage at the current price of $35. So this is September 2020. You borrow the shares, you immediately sell these borrowed shares at the market price at $35 each. So in your account, you're going to be positive $3,500. So 100 times $35 stock price. And you're going to have negative 100 shares of Nikola. So that's where you stand in September 2020. You're up $3,500 and you owe 100 shares of Nikola. Then you wait for the price to drop. So over the next few months, as the details of the fraud became, even more public, the stock actually began to drop quite significantly. And then eventually you're going to want to close out the position. So let's just say as of right now, sort of early 2024, the stock price has fallen all the way to 70 cents per share. So it went from $35 down to 70 cents per share. So you decide to close your short position by buying back the 100 shares that you owe. So you've got negative 100 shares in your account. You owe those back. So you buy 100 shares and that's only going to cost you $70. So 100 shares times the current price of 70 cents, that's $70. So you're going to profit a lot. So if you look at what you initially sold the shares for was $3,500. That was $35 times 100 shares. So at $3,500 was in your account. Then you wait and you bought back 100 shares and it only cost you $70. So the profit is going to be the difference here, $3,500 minus $70. So you've made $3,400 and about $3,430 there, obviously minus any fees. So you've basically almost, made 100% of your money by shorting this stock over the last 3.5 years, so to speak. So that's really a good return. Obviously, there's risks involved with shorting a stock, but that's how it actually works out. And that's how the numbers work out. And obviously, there'll be a little bit of fees or an interest that you pay to hold that short position for those 4 years. But that's it. You buy the shares, you borrow these shares, 100 of them at $35, sell them right away. You're up $3,500 in your account. Eventually, you just need to replace those 100 shares. The stock price goes way down to 70 cents. You buy it back for $70. Your 100 shares go back to positive, or go back to from negative. You get rid of those, you give those 100 shares back, and then you're up the difference. So that's how short selling works. That's how you short a stock. So I hope that you found this useful. When you really look at it, it's a very simple concept. You're selling high, buying back low, and you get that profit difference. But for me, I needed to go through those examples and that discussion regarding the brokerage firm and how it works sort of behind the scenes with, borrowing and then instantly selling. For me, I needed to kind of go through that. And obviously now I know how it works and I know that it's sort of seamlessly within your dashboard. But for me, I needed that. And hopefully, if you're listening, then that was beneficial for you as well. So I hope that you found this useful. Subscribe to the podcast. Again, if you are interested in becoming a full-time day trader, you can download my blueprint at stokestrades.com/blueprint. If you want to watch a video of that example that we just went through, then in the show notes, you can find the YouTube video. And I hope that you find all this useful and, download that blueprint and come see our community over at school. You'll get all the details after you download the blueprint. If you want an accountability partner, if you want to, have someone that's going to help you along this way, I am 100% committed to becoming a full-time day trader. In our group on school, the community that we're building, hopefully we're going to have other people that are extremely dedicated to this as well. And we can grow together. We can learn. We can set up courses that are all free. There's no sales. No one's trying to sell you anything. There's no ads. And it's just a really, really good platform to build a community on. So I hope to see you there, and I will talk to you in the next episode when we talk about options. Talk to you soon.